Hi Miss, my name is Chang Jia-yi.
Our group members are Xiaoxian, Yongqing, Naila, and Joe. Our group is going to present the comparison of taxation in Malaysia and Singapore. First of all, let's understand what tax system is in use in Malaysia and Singapore. Actually, both Malaysia and Singapore are using progressive tax system. Progressive tax system means that the tax rate increases as the taxable income increases. In other words, it imposes a lower tax rate on lower income earners and a higher rate on higher income earners. Next, let's look at our overview of the tax comparison. We will cover 4 parts. The first part is comparing the tax base and the tax rate in Malaysia and Singapore, which includes resident tax rate, corporate tax rate, and good or sales and services tax rate. The second part is going to compare the resident status. In Malaysia, we have 4 sections to determine the resident status, which includes Section 71A, Section 71B, Section 71C, and Section 71D of ITA 1967. On the other hand, in Singapore, they are using 2 tests to determine the resident status, which are quantitative tests and qualitative tests. Then, the third part compares the taxable income, allowable expenses, and reliefs of the employment income. The taxable income part will compare the provided fund in Malaysia and Singapore. Lastly, we will also compare the taxable income, allowable expenses, and reliefs of the corporate income. The taxable income part will compare the dividend income, interest income, and royalty income, while the reliefs part will compare the group reliefs in Malaysia and Singapore. So, let's start now.
Good morning to Miss and all my fellow friends. Hi, my name is Joel, and today I would like to present on the similarities and differences between tax base and tax rate on the country Malaysia and Singapore. First and foremost, we're going into the tax base on resident income or individual income tax. For Malaysian, income between 0, meaning have no source of income such as undergraduates or students, to 5,000, which are minimum wage workers, who are fully exempted from taxes. Moving on, income between 5,000 to 20,000 are charged with 1% of taxes. And lastly, 20,001 to 35,000 are charged with 3% of taxes. Moving on to Singapore, who charges their taxes differently for their resident income in Singapore's residents. First of all, they charge income between 0 to 20,000, or the first 20,000 people of their income are fully exempted. Moving on, 20,001 to 30,000 or the next 10,000 are charged with 2% of tax rate. And lastly, 30,001 to 40,000 or the next 10,000 are charged with 3.5 tax rate. Capital more or equal than 2.5 million. On their first 60,000, they are charged with 70% of tax rate, and their subsequent balance will be charged with 24% of tax rate. And lastly, companies that pay in capital more than 2 or equal than 2.5 million are charged with 24% of tax rate. However, in Singapore, they do it differently, as their corporate tax income more than 30,000 are charged with 70% of tax rate, and companies who are effective are charged with effective corporate rate of 8.5%. Lastly is the tax base on goods and services or sales and services tax. In Malaysia, it is called sales and services tax. However, in Singapore, it's called good and services tax. For Malaysia, they charge these taxes in 2 separate ways. Sales will be charged between 5 to 10%, while services will be charged on 6% on a flat rate. However, in Singapore, their goods and services are combined taxes. Unlike Malaysian does it separately, they combine off between goods and services which charge off 8% of taxes.
Hello everyone, my name is Naila Muhammad Haj and I will be representing the residential status. Residential status of Malaysia and Singapore. There are 4 sets of circumstances by which an individual is deemed to be a resident in Malaysia. 1. Section 71A said that in Malaysia for 182 or more days of which the period of stay need to be consecutive. 2. Section 71B, the number of stay should be less than 182 days. Must have a link to or link by. The link to or by year have at least more than 182 days plus temporary absence. While in Singapore, an individual must pass at least one of the following requirements in order to be considered a tax resident in Singapore. Test 1. Quantitative. This person was physically present in Singapore for at least 183 days in the year prior to the evaluation. B. Had a job that required at least 183 days of the work-related activity in Singapore in the year prior to the assessments, meaning excluding the directors of a company. The third circumstance by which an individual is deemed to be a resident in Malaysia is Section 71C. State that must be in Malaysia for 90 days or more. 3 over 4 previous year was either resident or in Malaysia for more than 90 days. And the fourth circumstance is Section 71D. It states that must be a resident for the 3 immediate previous year or must be resident for the immediate previous basis year. While in Singapore, the second test is qualitative test. It states that a person must be resident of Singapore or his absence from Singapore must be temporary and reasonable. Thank you.
Good morning, Miss. My name is Ng Yong Jing, ID number 2102048A. Today, I will present about the employment income tax in Malaysia and Singapore.
First is about the funds. In Malaysia is called as Employee Provident Fund (EPS), while in Singapore is called as Central Provident Fund (CPF). Both of the provident fund is to ensure the employees can afford the expenses towards their housing and medical bills and other. EPF program require employee to contribute 12% of their salary to the EPF account, which can be withdrawn on retirement age of 58. For the Singaporean have to contribute 20% of his salary. The share of the contribution starts from 30% minimum and it cannot be touched until the retirement age, which is 55 years old. There are few allowable expenses in Malaysia, but here we are just introducing a few types. First, monetary or near monetary benefits. Any wages, salary, remuneration, leave pay, and other in respect of having or exercising the employment is considered in these monetary benefits. Second, benefit in kind. It was an amount equal to the value of the use or enjoyment by the employee of any benefits or remuneration provided for the employee by or behalf of his employer. After that, unfinished accommodation is one of the allowable expenses in Malaysia and is an amount in respect of the employee use or enjoyment of living accommodation provided by or on behalf of the employer. Besides that, in Singapore also got fields of allowable expenses. Foreign worker levies will be the first to introduce. Employer who hire foreign employee with work promise of express pay monthly levies based on their qualification, sector, and foreign to residential worker ratio. Employee on employment pass earning Singapore $3,000 or more monthly are exempted from the levy. Next, work from home expenses such as electricity, telecommunication charge, and Wi-Fi expenses also can be deducted under the employment tax. For the relief part in Malaysia, when women returning to work can be exempted for up to 12 consecutive months but must apply to Talent Corporation Malaysia Berhad by 31st December 2023 and the exemption lasts until 2024. Singapore have a relief for working mother which is granted for each Singaporean child who satisfy all conditions under the qualification child relief or disabled child relief. It is a percentage of the mother earned income subject to a cumulative maximum of 100%. Rate for the first, second, and each subsequent child are 50, 20, 25% respectively. Lastly, foreign employee with a double taxation agreement can apply for the exemption from Singapore income tax in respect of dependent personal service rendered in Singapore. To do so, a complete certification of residence must be submitted to the IRAS.
Hi I'm Sienna. I'm going to present the corporate taxable income, allowable expenses, and relief. Malaysia and Singapore have the same taxable income, which are dividend income, interest income, and royalty income. The first taxable income is dividend income. Malaysia is under the single-tier tax system. Dividends are exempt in the hand of shareholders. Companies are not required to deduct tax from the dividend paid to shareholders, and no tax credit will be available for offset against the recipient tax liability. Corporate shareholders receiving exempt single-tier dividend can, in turn, distribute such dividend to their own shareholders, who are also exempt on such receipt. Singapore dividends are exempt in the hand of recipient. Second is the interest income. Interest income accruing in on derived from Malaysia or received in Malaysia from outside Malaysia is subject to CIT. Exemption granted include interest income earned by a non-resident person from deposit placed in designated financial institution in Malaysia. Singapore source interest income is taxable when it arises, and foreign source interest is taxable when it is remitted or deemed to be remitted to Singapore. Last is royalty income. Royalty income accruing on derived from Malaysia or received in Malaysia from outside Malaysia is subject to CIT. Payment to non-resident falling within definitions of royalty will be subject to withholding tax (WHT) requirements. However, certain royalty income earned by a non-resident person may be exempted from tax. Singapore source royalty income is taxable when it arises, and foreign source royalty income is taxable when it is remitted or deemed to be remitted to Singapore. These are the three income that were taxable in each country. Next is the corporate allowable expenses. Malaysia and Singapore also have same allowable expenses, which are capital allowance, start-up expenses, interest expenses, bad debt, donation to charitable institutions, and payment to foreign affiliates that can be deducted from income taxable. Other than that, Singapore also have research and development expenses can be deductible. From the year of assessment 2019 to 2025, enhanced tax deduction of 215% of qualifying expenditure is available for R&D carrying out in Singapore, subject to condition. Where the R&D is carrying out overseas, a deduction of 100% of qualifying expenditure is allowed. Expenditure incurred in relation to R&D cost-sharing arrangement are accorded the same tax treatment as R&D expenses. Income tax are generally not deductible in determining corporate income. However, irrecoverable GST is deductible under certain circumstances. The FWL and property tax are deductible to the extent they are incurred wholly and exclusively in the production of income. Last is the group relief of Malaysia and Singapore. In Malaysia, a company that qualifies for group relief may surrender a maximum of 70% of its adjusted loss for a year of assessment to one or more related company. The period in which a company may surrender its adjusted loss is limited to the first 3 consecutive years of assessment following the basic BIS period for the year of assessment in which it commences operations, provided the basic period consists of a period of 12 months. However, in Singapore, to qualify for the group relief, company must be incorporated in Singapore, belong to the same group of company where, among other things, there must be at least a 70% ownership relation between claimant and transferor, and has the same accounting year end. In addition, a group must comply with certain prescribed offset and apportionment rules.
That's all of our group presentation. Thank you.